Large corporations function as bounded ecosystems, housing semi-autonomous divisions that must continuously trade with one another to build a final product. This physical exchange, moving goods from a seller to a buyer, generates an internal invoice that requires a specific value. This accounting mechanism is known as transfer pricing. It serves as the internal exchange rate used to value the transaction between these two corporate segments. This internal market is constantly pressured by the external world, where independent suppliers and buyers compete for the seller's capacity and the buyer's capital. Because of these external forces, the transfer price is a dynamic variable, shifting based on the selling division's available factory capacity and its specific cost structure. An inaccurate exchange rate alters the incentives for division managers. If the price is poorly calibrated, localized decisions can inadvertently erode the consolidated profits of the entire firm. Executive management must prioritize goal congruence, ensuring that every internal transaction maximizes the total consolidated profit of the company. Simultaneously, the company relies on segmental autonomy, allowing managers to operate independently and receive fair evaluations based on their localized profit and loss. Tension arises when a transfer price designed to benefit the entire company forces a selling division to record a localized loss. Conversely, if the seller extracts maximum profit from an internal buyer, that buyer may choose to spend corporate cash on an external supplier instead. To manage these conflicting motives, top management must mandate a standardized transfer pricing policy. As a behavioral control mechanism, the chosen transfer price influences division managers to make localized choices that align with the goals of the firm. We see these trade-offs in the Fordyce case. Division X makes product A with direct materials at $7, direct labor at $3, and variable overhead at $1.50. Under a variable cost policy, the transfer price is $11.50. This price encourages the buyer to utilize the seller's unused factory capacity. However, this method provides no incentive for the seller. Producing goods at exactly variable cost leaves the division manager with zero contribution margin to cover their own fixed expenses. The full absorption cost method addresses this by including a fixed overhead allocation, resulting in a $13.50 price. While this ensures the seller avoids a localized loss, it removes the incentive to control production costs, as all inefficiencies are simply passed through to the buyer's ledger. Alternatively, a market price of $40 is used when the seller has zero idle capacity and could sell externally. Finally, a negotiated price uses the variable cost as a floor and market price as a ceiling. These accounting selections unilaterally shift internal wealth. To remain economically relevant, the final price must be grounded in the physical constraints of the factory floor. Those physical constraints become unmistakably clear when a manufacturing facility's production line reaches its absolute full capacity and cannot produce a single additional unit. Consider Division A, producing a part for $6 and selling it externally for $10. Division B wants to buy this internally, though an outside supplier offers $9.50. If A's factory is full, the price remains at the $10 market rate. Diverting those parts to Division B requires A to abandon a profitable external sale. This creates an opportunity cost that the corporation must account for. The math shifts under the excess capacity rule. If the factory sits idle, that opportunity cost disappears, lowering the logical price floor. Looking at the cost structure, Division A's $6 cost includes $4 in variable costs and $2 in fixed overhead. With idle machines, any price above the $4 variable cost provides a contribution margin that helps the seller cover their fixed expenses. Physical capacity determines whether an opportunity cost exists, making it the primary factor in setting the internal price range. We can apply this framework to a set of raw data to find the exact bargaining parameters between two divisions. Here, a fabricating division acts as the seller, and an assembling division acts as the buyer. The critical variable is capacity. The seller has 1,000 units of idle capacity, exceeding the buyer's need for 900. Since the factory can fulfill the internal order without sacrificing external sales, the opportunity cost to the firm is zero. The absolute price floor is $20. The seller won't accept below its incremental variable cost. The absolute ceiling is $50, the external market price. This establishes a logical bargaining range between $20 and $50. The limits of external markets and internal variable costs define this defensible range, providing the parameters for a mathematically sound transfer price. Some firms attempt to bypass these negotiations by allowing each division to record the price that most benefits its own ledger. Under dual pricing, the seller records a $50 sale at market price, while the buyer records a $20 expense at variable cost. This accounting choice makes both managers look successful on their segmental performance reports, avoiding internal friction. However, the $30 difference between these prices creates a phantom corporate subsidy that does not exist in the real economy. Because high margins and low costs are guaranteed by this ledger entry, managers lose the incentive to control actual production costs. Decoupling internal metrics from economic reality in this way forces the corporation to subsidize operational inefficiency. These factors lead to a single overriding rule for segmental evaluation. The segment making a transfer must recover its incremental cost plus the opportunity cost of that transfer. True opportunity cost only occurs when the selling division operates at its full production capacity. By aligning the localized drive of the division manager with the consolidated survival of the firm, the optimal transfer pricing policy turns individual self-interest into a corporate asset.